My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to a special CEO Council Summit edition of Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to help you make some money. My job, not just to entertain, but to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Right now, we're playing out so many horrible scenarios that I thought were over with and done with, but we weren't, which is why the Dow tumbled 256 points today, S&P lost 0.73%, and the Nasdaq declined 0.61%. I worry that this awful sense of deja vu is going to drive people out of the market once again. I'm talking about the rabbit hole of 2011 and the great COVID wave of 2020 to 2021. The first one's nauseating, but also obvious given that 2011 was when we had that last true debt ceiling crisis. It was only natural to worry that history from 2011 would repeat itself, meaning that the situation would get a whole lot uglier before it got good. It's certainly getting uglier. The second one, COVID, the idea that it could become making a comeback and in huge numbers, some say as many as 50 million infections in a week in, yes, China, has created a level of shock that's sending everything related to China down, from Freeport McMoran, the giant copper producer, Starbucks, where they're opening a new Chinese store every 9 hours. Of course, we can deal with COVID. We have lots of ways to make it less lethal. Here in America, it's almost become a rearguard action. But COVID here and COVID in China are two very different things. There's an awful lot of mystery about this new variant in China right now. We don't know if the government will shut things down. Apparently, they're saying they won't. We don't know if travel will be banned or restricted, although the casino stocks with exposure to Macau are trading like it's going to happen. And we don't know if the psyche of the recently ebullient Chinese consumer will be impacted. I was worried when I saw those numbers from Alibaba, the Amazon of China, but that was before this new COVID wave. Jeez. The worst part is that almost nobody even knows about this new COVID wave. I talked to dozens of people out here at this terrific conference, and I seem to be the only one who was even aware of it. That's kind of like back in February 2020 when I came on air and people looked at me as if I had 5 heads when I said an epidemic was coming. As it keeps spreading through China and possibly beyond, there'll be a sense of discouragement and disgust, the two Ds that make people want to sell their stocks. All right, let's talk Washington. When you rewind the tape to look at the day-to-day action from the last debt ceiling negotiations in 2011, it's not good. We had a lot of optimism about a deal back then. We figured nothing could really go wrong with the debt limit because it had never really gone wrong before. The debt ceiling was always a formality. The idea that a bunch of elected officials could hate each other so much they'd be willing to destroy the government's credit rating just to prove a point, it seemed insane. The only point they'd really be making is that America is run by a bunch of morons, and the full faith and credit of the United States government isn't worth the paper it's printed on. But they almost let it happen. Even though we ultimately got a deal and averted the worst-case scenario, the stand-up was enough to make the Standard & Poor's company downgrade our government debt. It was just so embarrassing. It caused a lot of selling, a lot of worry. This time, we're repeating all the same mistakes, except almost nobody's optimistic because we know how bad it can get. We're no longer in denial about the level of dysfunction in American politics. We're much more cynical and jaded these days. Now, I spent the last couple of days reading the archives from 2011, and several things jumped out at me. First, we got to a point similar to where we are now, when we sensed that things were really going off the rails. That was about a dozen trading days before they came to a deal, kind of where we ended last week this time around. During each one of these trading days, hope would be kindled at some point and then exhausted, and often several times within the same session. This time, the rhetoric's mostly about how people might not get their Social Security checks or some Treasury auctions might fail. But last time, we focused on the ratings agencies as they leaked that the country would lose its top credit rating if something wasn't done and done quickly. There was tremendous fear that a downgraded Treasury would be a sold Treasury, and interest rates would shoot dramatically higher. At the same time, there was a widespread belief that our economy would go into recession the moment the government defaulted, and it would get worse every single day there was no agreement. Now, both yesterday and today were reminiscent of the period in 2011, because you'd have a couple of stocks, a couple of companies do well. See, you'd see something like we had Palo Alto Networks on last night, PNW, which reported an amazing number. And then its stock shot up big, but there'd be very little pin action for even the other cybersecurity companies, even off a classic roll. You'd see a great quarter like we just got from Toll Brothers, but because it's a home builder, that industry's in the crosshairs of the debt ceiling morass, it rallies, but much less than it would have otherwise. You know what? I actually wonder if we won't see the same one-off action in the stock of the amazing NVIDIA, the incredible AI kingpin. which crushed the numbers better than any large capitalization company I can recall in 2023 when it reported tonight. I tell club members, CNBC Investing Club members, they know it. NVIDIA, own it, don't trade it. An honor I hold only for Apple and NVIDIA, and I reiterate that stance right now. But will the huge move in NVIDIA be able to buck the budget undertow? Not if things get real nasty. Back then, as we got closer and closer to the default date where the government wouldn't be able to send out the checks, a disputed date, by the way, because the Republicans kept saying we have more time than the Democrats did, the market just grew uglier and uglier and uglier. Like then, this market's choosing to take apart the industrials and the financials. But as the market started to really get hit, as the game of chicken in Washington got ever more dire, Washington took everything down in the end. Today on my morning meeting home stretch shows with Jeff Marks, the ones you can watch if you join the CNBC Investing Club, I actually pondered whether, given what we know about 2011, it would actually be possible for some members to sell out and then get back in, avoid some declines, particularly in the industrials and the financials, rather than just keep taking the darn beating. Honestly, as someone who used to trade for a living many, many years ago, I can see how you might want to do that. We just aren't oversold enough to bounce on the traditional market edge oscillator I use to measure if there's too much selling pressure. The complacency is actually pretty strange given the 2011 script, I gotta admit. Plus, right about at this point, the 2011 debt ceiling debacle, we started hearing from journalists with dubious sources that there were really only 8 more days worth of basically hidden cash that could tide us over. That's what made things drag on back then, even as we did ultimately reach a deal on the eve of the original X day. I would hate to advise you to sell and then buy back later. We don't know if you'll be able to get back in after the all clear is sounded. Real nimble people can probably dodge maybe several percentage points, maybe 5, 6, 7, maybe more. But if you aren't nimble or don't want to take those gains, I say get ready for your politicians to lose you some more money until this is over. Bottom line, they hurt you then. They aren't done hurting you now. But unless you trade full time, it's very hard to get out and get back in early enough for it to make a difference, which means most of us just need to take the pain. Recognizing that a month after the debt catastrophe was averted in 2011, we were much higher and made a ton of money together. Dustin in Oklahoma. Dustin.
Booyah, Jimmy Chill. How you doing, sir?
The Chill Man's doing well. How about you?
I'm doing fantastic. It's good to talk to you again, sir.
Thank you.
My question tonight is about one of our club names. I am one of our charter club members, and my portfolio leans a little bit more tech-heavy, which has been really fantastic this year. But I've been considering a name in our portfolio for quite some time. It's an industrial growth, and just don't know when a good time to pull the trigger with the debt ceiling right now. I wanted to know your thoughts on when to pull the trigger on Caterpillar.
All right, I think Caterpillar is terrific. The way the debt talks to God, I was hoping, and hope shouldn't be part of the equation, that Caterpillar would begin to rally on all the stimulus money. But at the same time, I thought the debt, I didn't think it would get this bad. I think you got at least 4 or 5 more days for it. You could see Caterpillar lower. And I don't want you to get in and then say, why did Chill say buy it here when he knew it was going lower? So I do think the Cat could have more downside, and then you will have to buy some. I'm going to Ian in Illinois. Ian.
Jimbo, how you doing, my friend?
I'm getting hot. How about you?
Yeah, I hear you. It's beautiful in Chicago today, so I'll take it. But hey, listen.
All right. What's happening?
Yeah, I am 31 years old, and I'm trying to balance my portfolio with some riskier upside plays, as well as some cash flow producing investments. And one of my favorite cash flow stocks is Realty Income. So I'm looking for your thoughts on the health of the company, where it might be headed amidst this
Realty Income, letter O, is fantastic, Ian. It's a terrific company. It stood the test of time. I think you get those monthly dividend checks. I think you got horse sense. All right, if you don't want to sell in the face of the debt ceiling deadline, then get ready for some more volatility because it might get ugly in Washington. Man, tonight, Cadence shares are up a whopping 382% over the past 5 years, while the S&P's only up 50. I'm talking with the CEO about the company's outperformance. Then I'm checking up on a comeback story that we've been watching closely in the utility space, PG&E, to see if its recent pullback could be a good opportunity for investors. And Snowflake shares melting after earnings. I got the exclusive with the CEO when this special edition of Mad Money from the CNBC CEO Summit continues.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.